Welcome, everyone. Good morning. Welcome to KWB Wealth's Economic Outlook. My name is Elena, and I will be your host for today's webinar. We'll be hearing from Steve Gormley, Rachel Bebb, and Claire Lucchese. Before we begin, please take a moment to read the disclosure on the next screen. This is being recorded and will be available for replay on our YouTube channel. We'll also have time at the end for a Q&A, so feel free to type in your questions at the box below at any point. And with that, I will go ahead and turn it over to Steve to get us started.
Hey everybody, Steve Gormley, Director of Portfolio Management here for KWB Wealth. I did this last year, the 2025 Economic Outlook, and it seems like we're going to say the same information, but one of my favorite New York Times authors, Jason Zweig, he said his job was to say the same thing 50 times a year, but try to do it differently so that it finally sticks in people's brains. So, yeah, I've been with the firm here for 17 years. Again, I'm the director of portfolio management. Been basically doing that the whole time. So, uh, you know, really excited to get this going. So I'm going to toss it over to Rachel, and she can introduce herself.
Good morning, everyone. My name is Rachel Bubb. I am a wealth manager here, also business development officer. So excited to be here. I've been with the company for almost 8 years. It'll be 8 years in July. And this is going to be a fun little conversation between the three of us. And I'll let Claire introduce herself next.
Good morning, everyone. Thanks for joining us today. My name is Claire Lucchese. I recently got married this last year. My last name used to be Olmsted, and so we've been having fun around the office trying to pronounce my new last name. I even got asked if I was Italian yesterday, so I feel like that's a win. With the firm for 5 years this upcoming July, and I am a wealth manager. It's been an awesome journey, and we're just excited to get this economic outlook going and talking about 2026. But before we jump into the fun stuff, Steve told us let's have a little bit of a palate cleanser, you say, right? So let's talk about 2025 and some of the exciting things that happened. Well, whoever you are, whether you watch the news or you keep up with pop culture, I feel like most people have probably heard that Travis Kelce and Taylor Swift got engaged this last year. Very big news. Yes. We had the Louvre heist with the jewels this past year. What else? I mean, just lots of crazy things. We had the Coldplay cheating scandal. That was a whole situation. So lots of exciting things and just more to look forward to for 2026.
Yeah, and those are just some of the fun stuff. Remember, I was telling him this morning, I almost forgot that we had a government shutdown, and
Right.
that was the longest government shutdown that we've ever had. So, more fun things happened, like Travis Kelce and
Exactly.
Taylor Swift. But and what are we looking forward to in 2026? So, besides all the economic stuff that's coming up, we're going to talk about that. 2026 is a big year. It's the 250th year anniversary for the United States. We also have the World Cup coming to the United States this year. It's going to be in 11 different cities, and one of them is actually going to be in LA. So that's a cool thing. And Winter Olympics is coming. So it starts on February 6th, goes all the way through the 22nd, and it's going to be in Italy. And most importantly, this is the 50th season of Survivor upcoming
Woo!
for all of those TV goers.
Survivor head? Yeah,
I'm
Yeah.
a
Survivor
huge
head? I don't know
Survivor
what you would
head.
call
Yes.
Yeah.
Yes, definitely.
it.
Um,
Well, I know
but
I'm looking forward to. I have a big trip with my kids going back to the East Coast for spring break. Uh, Boston, New York, Philadelphia. So that'll be a good trip. Some historical stuff. So 250 years of history, and we're gonna pack it all into 10 days, hopefully.
cool.
Yeah. All right.
Well,
Well, let's get this thing started. 2026. So let's start with headwinds and tailwinds. So whenever we think about the economic outlook for the United States and for the world, really. It always starts with like, all right, well, what are the things we have going for us, and what are the things that aren't going to be going or are going to be going against us for the next year? So the first thing I don't have a slide for, but the first thing that we've heard is that with the One Big Beautiful Bill Act and some of the tax extensions and some of the tax cuts that happened through that, there's an expectation that the tax returns that people will be getting in the first quarter and into the second quarter will be a lot larger than they were last year. And so that could be a really big economic headwind as people, have more money in their pockets and are more willing to spend. So I would expect actually GDP to be pretty good. The gross domestic product, how the economy is growing to be pretty good in the first half of this year because of that tailwind. So that's a something that we're looking forward to. And the economy is 70% driven by the consumer, and when the consumer has more money to spend, it's always a good thing.
It's
And
been
so let's
interesting, Steve, when we've
yeah
been doing planning and tax planning for our clients. That's something that we recognize that these new senior deductions, if you're 65 and older, you're getting an additional 6,000 per person. So the standard deduction for the 65 and plus has gone up to about almost 40, like a little over 42,000. Now there's some, if you make a certain amount of money, you don't get as much of the deduction. But that's something that we've been working with on clients is like, okay, how do we maximize and try to get as much of the senior deduction as we can? And we are seeing that more people are getting a larger, I don't want to call it like a windfall though,
yeah
because of they don't have to pay as much in taxes.
yeah that's great. Yeah, great news for the economy, great news for companies and all that stuff. So great. I'm glad that the planning side of it is seeing that as well. All right,
Yeah.
let's go into the let's go into the first chart. So another tailwind that we see for 2026 is earnings. So when you break down how the market performs on a year by year basis, it really comes down to three components. The first is dividends, and we know what dividends are going to be. They're going to be right around 1%. It's not as large of a proportion as it used to be throughout history, but we know that we're going to get about 1% in returns from dividends. Second is earnings. And as you can see from this chart, earnings are expected to grow in 2026 and in 2027 by around 14%. So kind of have a baseline of about 15% there, where expectations for earnings, and now earnings are one of those things where they can be wrong, but analysts tend to do pretty well, except when they don't. When they don't, they're way, way off. And so you can see in years like 2020 and back in 2008, 2009, analysts were quite a bit off, but typically when things are going well, they are pretty accurate. So let's just say we have a baseline of 15%. The last thing that comes into uh, components of return for the market is what are people willing to pay? And so we don't know that component. We never will. And so that is the one thing that can throw off any year is like, hey, people who are buying stocks just don't believe that they should be paying as much as they used to. But from the baseline of, hey, we have really good earnings expectations, we've got a little bit of dividends, we could see the market continue on its track that it has for the last few years. And so we're pretty excited. That's a pretty nice tailwind for the economy is that companies continue to earn. And the one thing that I was thinking about as I was looking at this slide and thinking about like when I was a kid, I have two young kids, an 11 and an 8-year old. And, when I was a kid, the people who I thought were wealthy, the people who I thought were rich, all of their parents owned a business. They were painters or they were construction, owned a construction business, things like that. And I never thought that that would be me. But when you think about what you're doing when you buy stocks, is that you are really becoming an owner of these companies. If you buy the S&P 500, you are owning 500 different companies, and you are becoming a very tiny, small owner in each of those businesses. And so it's the greatest wealth creation force that you could ever think of is like, hey, anyone could be an owner of one of these companies. And so when you think about what you're buying when you buy stocks, think about I'm becoming an owner of all of those different companies and that power, that wealth effect. And these companies want to continue to earn and they're going to do whatever they can to earn more returns for their owners as time goes on. So just a really powerful force and something I was thinking about as we were putting together the charts that were one more tailwind. If we go to the next chart, The Fed. So the Federal Reserve controls the short-term interest rates for banks. Uh, the expectation of the market is that we should get 1 to 2 more rate cuts this year. I believe that President Trump is going to be appointing a new Fed chief. And that Fed chief, the expectation is that they are going to be much more accommodative and want to lower rates maybe even more. So the expectation, as you can see from the chart, is that we're between 3.75 and 3.5 on interest rates, and the expectation is longer term we should be around 3. That could go even farther depending on who Trump appoints and what happens with the economy. But the saying in the industry goes, don't fight the Fed. You can see in 2022 and 2023, the Fed was raising rates. 2022 was one of the worst years for stocks and bonds that we've seen in a long time. So again, don't fight the Fed. When the Fed is raising interest rates, you should expect things are not going to go well. But as interest rates continue to fall, should be good for smaller companies who have to borrow more, hopefully should be good for the housing market. Maybe we can get that unfrozen a little bit and moving a little bit faster. So the Fed lowering interest rates for us is always going to be a tailwind. So one more thing to look forward to. So what are some of the tailwinds we're looking at? So if we
Hey
go to the
Steve, before
yeah,
you move on from that, one concern that we've been hearing and it's been going across the news is the Fed losing some of its independence because of some of the pressure that we're getting from the current administration.
right.
Now, is that something that you see as a concern, long term, short term for, I mean, when we're talking about this in the markets for 2026?
I say this all the time about different things when it comes to politics is there's a pendulum. It swings back and forth, between right now we're talking about Fed independence and what that means. And, if you go back to the 70s with President Nixon, he was also one that would really hound on his Fed chief to like, hey, I think we need to do this with interest rates. We need to do that. Luckily, the Fed chair doesn't control everything. It's a board. It's a board of a bunch of different Fed presidents. There's just one that happens to be the chairman. So while he can appoint the one, he can't really do much about the other 12 or so that are actually setting the interest rate. So while it might be concerning in the short run, like, hey, the Fed is, or the president is kind of manipulating or trying to manipulate interest rates for what he thinks is the right thing. Overall, I think the Fed's job is the dual mandate. One is low unemployment, and two is controlling inflation. And they're going to swing back and forth between those two things. So right now, hopefully, inflation is under control. We dealt with inflation for the first time in a long time, and I think that really spooked a lot of people. But right now, I think what we're coming into is we're looking at the job rate and the rate of hiring, and the Fed is probably trying to turn its approach and saying, look, we do have a dual mandate. We got to look at both sides of this coin. So I think that Fed independence will continue because there's always going to be two sides of that coin, that dual mandate. So they have to look at both. If they're only looking at one, either the economy is going to get way overheated and then we're going to go into recession, or they're going to be looking at inflation too hard when jobs are not being created, and we're going to go into recession the other way. So there's kind of a yin yang. There's a necessary evil of the Fed, or a necessary good of the Fed, is that they have to look at both sides of that coin. So if we go into the next chart, you'll kind of see one of our headwinds, and it's exactly that, is that the Fed right now is starting to look at the employment picture because it's become a lot bleaker than it was throughout 24 and 25. So over the last 6 7 months, you can see that we've had kind of this up down approach with how payroll gains and hiring is happening over that time frame. And you can see we even had a really big drop in October. So the Fed is now having to say, look, we've got to look at this from a different standpoint. Inflation is coming down. It's probably not at the place they want it to be, but there's a natural kind of equilibrium where maybe rates are a little bit too high because of that hiring picture. So that's one of those tailwinds as we continue to look forward. We want to see that job picture kind of come on the upturn because as of right now, that up and down, not very much hiring, that could really lead. Again, 70% of the economy is what the consumer is doing. If you don't have a job, you're not consuming. And so that's one of those things we're always looking toward as far as headwinds and tailwinds. And right now, that's a pretty big headwind. One more headwind, if you go to the next slide, is the presidential cycle. So the midterm election year tends to be one of the worst in terms of volatility, and it is the worst throughout history, going back to 1950. We have the biggest drops in midterm years, and I think that has to do with a lot with um, I think it's like a malaise that happens in the middle of a presidential cycle. And like, is this president getting things done? Is Congress and the Senate, are they getting things done? And that's why we tend to see big shifts. You know, when we have a red wave like we did in 2024, you might see a lot more blue come across in 2026. And so that tends to lead to a lot more volatility in the stock market. But the one thing to look for uh, after that volatility hits is that what coming out of that is the biggest gains that you see. And so it you know it's that teeter totter of like, hey, when things are at its worst, that's the best time to buy. So just know that we're looking for volatility. We know it will happen. We know it happens every year. But what comes from that is what is the best returns that you can see. So we're not gonna be going in and selling anything with expectations that it's going to happen. We just know that it will, and we know that it's going to bounce back. So that's one thing. But it is another headwind that we're seeing because this is just the way things happen in presidential election years or non-presidential election years. And so if you go to the next slide, there's one more. Midterm election year tends to be the worst on average of the four years. With a new president, we basically get no gain. So that's that volatility coming into play. But with a second term president, and President Trump is a second term president now, it's not consecutive, and he's the only one. So there's no like there's we can't show you a chart as to what the market does when it's a non consecutive president. But typically in a second term president, the midterm year tends to be a little bit smoother. So hopefully we see some of that as we go into 2026 and 2027. And you can see 2027, you can see what the next year tends to be. Again, just playing off that last chart, the biggest gains come off of the most volatility. So just know that we're not looking at this from a year to year basis as like, what are we going to do in portfolios? We're looking at what matters over the long run. And over the long run, if you're out, and I know Rachel will hit on this later, if you're out on some of the best days, it can be really detrimental to your long-term performance. So I'm going to throw it over to Claire. She's going to talk about probably the biggest question that we've been getting over the last couple of years, and she's our resident young person, so she's gonna
Yeah.
she's gonna walk us through AI.
Thanks, Steve. Great job. So yeah, we're talking about AI today. And when we look back to last year, we did this same economic outlook. Steve mentioned this earlier, very similar information. The difference today is that AI was just kind of a bullet point of the conversation, and today it has its own section. So it's definitely something that is transforming the daily world that we live in. Everybody on this webinar today has probably interacted with AI at least within the last couple of days, if not today in itself. So AI is something that is drastically changing the world every single day. And so, kind of when we think about AI and trying to explain what AI is, it's really new. And we're still trying to figure out the implications of what it means, works. But the best example I could come up with, and I got the help of Rachel and Steve on this, and also my husband late last night, about explaining how AI learns. If you think about AI and how it learns, think about a race car. So AI learns like a race car practicing a track. It crashes, learns, and improves just at a much faster rate than humans could. If you think about driving a car, each time you do a lap, you're going to learn something about the track that's going to hopefully help you to, make your next lap faster, more efficient. That's how AI works. It runs millions and millions of laps each time, learning and improving. And that way, it's able to just drastically become more efficient. And the key difference, I think, between AI and a human is speed. Us as humans, we could run maybe 100 laps a day. I'm not a race car driver, obviously, so I'm not totally sure on that. But with AI, think about that race car running millions and millions of laps. It just learns at an exponential rate. And so if you think about that same concept and we apply it to people, companies, businesses, that same level of being able to learn and improve and have efficiency and reducing cost helps businesses run better, helps companies run better, helps people run better. And so I think overall, that's going to lead to positive change in the world. And that's why we're seeing all of that today. So kind of looking back to 2025 and even ahead to 2026, biggest question we've been asked this year, is AI a bubble? So we can pull up our first chart. We'll definitely get into this. The short answer, at least from what we're seeing as of today, is no. If we look at this chart here, you'll see that the light blue line represents the tech bubble that crashed in the late 1990s. And then the dark blue line represents the current tech cycle that we're in today. When we're looking at things like bubbles, it's important that we look at the valuation of companies. What are they worth? Is it worth what, the price of the stock is? A good tool for doing that is looking at what we call forward PE ratio. And so how we compare the current cycle to the tech crash is if you look back, this chart shows the 5 years leading up to the bubble popping, essentially. And so you'll see that forward PE multiples, traded at 43 times earnings. And so what that represents is that the price of the stock surged dramatically while the earnings weren't there to support it. And so it led to overvaluation of companies, and the stock price is what was driving that return, not earnings. Steve just talked about this earlier. Earnings are such an important part of projecting and understanding the health of companies. And so comparing that to today, we see that valuation multiples are pretty flat, and that's because the earnings are there to support it. And so even though we do have high prices, yes, there are high prices in tech, that is normal, the earnings are there to support it. And so this kind of even leads to our next chart that explains a lot of what are the earnings. So this chart shows the Mag 7. So this is going to be the 7 biggest US tech companies, most influential tech companies in the world. This chart shows the Mag 7 minus Tesla. And so we look back over the last 12 months, it shows that combined between Meta, Amazon, Nvidia, Microsoft, Apple, and Google, they are producing $1.1 million of net profit per minute, just looking back at the last 12 months. And so that just speaks to the insane amount of revenue generation that's being created because of AI. That also leads to people saying, well, there's a lot of companies spending money and putting money back into these companies, and that's why earnings are high. Yes, there is a lot of reinvestment happening, but when we look at the books of these companies, they have so much what we call free cash flow. After everything is paid, after all operating expenses, what does a company have left to essentially reinvest in their business? And that's what we call that free cash flow. And so these companies are not leveraging, they're not borrowing, they're not, going out and getting, extreme financing like we saw in the tech bubble crash. And so, again, short answer is no, we don't see a bubble. And you can see here that the earnings and the growth that we're seeing are the reason why that is. And so even though prices are high, when you have the earnings to support it, that's why you see those multiples at a low point. And so doesn't mean that there's not still going to be volatility and some stabilization, I think, in the tech sector. And so this kind of leads to our next point of what does 2026 look like for AI? It's tough to say. I think that long term, the statistics and the things that we're seeing as far as what AI is doing in the world, what these companies are doing, the revenue that they're generating, I think is overall going to be something that's relatively positive. I think that AI is essentially an ecosystem. It's like the internet. It's like smartphones. It is going to change the world we live in. And on the flip side of that, companies are adopting AI. Even us here at KWB Wealth, I'll give you a prime example. We've started utilizing AI to transcribe our appointment notes. So when we're sitting across from you at a meeting, instead of being focused on jotting down important details or important numbers, we can sit and be focused and present and have a more better conversation than having to sit there and try to write down facts, because we have AI in the background being able to catch any of those details that maybe we missed, which obviously comes back to the client and making a better experience for you. And so I think we're going to see the productivity gains happen across the board in all these different industries. And I think that's going to be a positive thing for the market overall. So you have AI that in itself is growing. I think companies are going to experience significant productivity and efficiency from AI. Of course, there's still some red flags, though. Another big question that people ask is AI going to replace me? We talked about this last time. And when we think historically about technology, technology has never been about replacing people. It's always been about replacing tasks. I think that's going to be the same thing today with AI. I do think that the world is changing. I think that jobs are going to be different. I think AI is going to change the way that we work. And yes, definitely some job displacement in the process of that, but a lot of job creation as well. So overall, when we're kind of looking ahead, long term, I think AI is going to drive significant growth to our economy. They're saying that, 0.5% of additional growth GDP wise just from AI alone in the next, 5 to 10 years. So it's exciting to see what's happening. I encourage people, be observant. Look at ChatGPT. I think we got Carrie to type in some prompts about fishing lures one time, and he was amazed. Trust me, you start using AI, you will definitely understand why it's so transformative. So overall, when we kind of look ahead, it's I think going to be a positive thing long term. In the short term, it doesn't mean that there's not going to be stabilization and volatility. And so in times of transformative change in the world, it's always important to go back to the basics and the fundamentals of financial planning. And, that's where, Rachel's really going to take us next.
Yeah, I think going back to like the short term, maybe some of the concerns with AI, when we look at it even from a planning perspective, I know I'm speaking with clients that maybe we're even thinking about retiring at some point. Or obviously they want to retire, but they were thinking about a couple more years. But now with the run up in AI and companies incorporating it into their businesses as quickly as possible, some of these older people that I'm speaking with who thought they might wait another year or two are thinking, I don't know if I might want to just go sooner because they're expected to learn a new technology, just the way that the younger generation is expected to learn when they're getting into the new job. So I think we might see a shift in the amount of people retiring. Maybe they do it sooner rather than later, kind of like COVID, where we saw this influx of people retiring because they went home, they didn't want to go back into the office, and they're like, this is pretty good, and I can afford to retire. I think the other thing in the short term we might see, and the companies will have to figure this out because we are seeing a reduction or like in the amount of jobs available for entry level positions. So a lot of people coming out of college right now are really struggling to find their first job, especially within tech because, well, we can get AI to do a lot of that coding. Now they still need someone to come in and make sure that the coding is correct. At least that's what I'm gathering from a lot of my friends that work in the space. But they don't necessarily need as many people as they once did to do those entry level positions. But then what the companies are going to see is a leadership gap because they didn't bring anybody at entry level, but now they need people at a second or third level, but they didn't train anybody and they don't have the leadership skills. So that's something that long term I think companies are going to have to reconcile with. At this point, they're not focused on it because they're spending all this money on building out the AI, and I think it'll be a problem maybe in the next couple of years that they figure out how to deal with.
Yeah, I mean, to talk to your first point too, with my grandma, she's the best, but I call her about once a week. And, every time I call her, it's hard for her to like answer the phone or send a text. And so I try to coach her and talk her through it. And then the next week, the phone updates and it's like a whole new experience.
Oh, yeah.
So the whole world of things are changing, technology and the frustration of not wanting to learn something new is totally relatable on all scales. So I definitely think you're right. You're definitely going to see that. And as far as the hiring goes, yeah, I think looking back, and Steve talked a little bit about this as maybe, a headwind, hiring is definitely sticky. And so part of that, I think, too, is companies sitting on the back end saying, hey, we don't know what's happening policy wise. We're just going to kind of pump the brakes. And once things kind of get cleared up, maybe we'll expand. Yeah, jobs are changing. I think Gen Z is resilient. I have to stick up for us
Yeah.
here. And maybe you guys can say this too, but what you learned in school or what graduated doing is not always the same thing that you end up doing. And so I was talking to somebody the other day. She was graduating marketing at NYU. And she said that when she was in school, they taught her that emails were everything as far as
Oh,
marketing goes. And obviously the world has changed just so much. And so I think it's important to be adaptable. But yeah, I'm curious. I believe in Gen Z. I believe we're resilient. But yeah, definitely curious to see what happens for sure.
yeah. So it goes into a great, you just said adaptable, Claire, and that's really what we build financial plans around is making sure that your plans are resilient, they're flexible, they're adaptable, because at the end of the day, there are all these things that we can't necessarily control. We can't control interest rates, we can't control inflation, we can't control the jobs market and what's happening at Meta and Google and their hiring. But what we can control is how we prepare and plan for the situations that are inevitably going to arise, whether it's a volatility, a recession, all of that is going to happen in your lifetime. So, what we want to focus on when we build out your guys' financial plans is being conservative and then doing things like stress testing to make sure that at times where the market's going to have a 15% decline, which we know on average happens every year, you can withstand it. And the way that we do that is through low assumed growth rates. So most of our plans or all of our plans are assuming a growth rate of 5%. And we do sometimes get pushback on that. Well, why not assume a higher when I look at my portfolio, it's returned better. Yes, that's great, but it's not something we want to plan for. If we can build a conservative plan and you make it, then that just means that over time you're going to do better and that you will have more flexibility and financial freedom. And that's what our goal is. We also build in extra expenses because we all know that we might plan to have a budget, but budgets don't always stick. We have a roof leak, we have a wedding to prepare for it. Who knows? So we want to be able to anticipate and forecast those out into your financial plan. In 2025, some of the things that we focused on doing in your plans and your investment strategy, we're going to continue to do on into 2026. And 2025 was a year where diversification worked and staying invested in the market worked. And these are things that we've preached not just in 2025, but years before, and we're going to continue to preach moving forward. So let's pull up the first slide, and I want to show you how asset classes did over 2025. So in here in this chart, you can see that there was not one, they didn't all perform the same. Gold actually was an outperformer. It had its best year since 1979. So it was up about 64, almost 65%. We still think gold is not a long-term strategy. It is something in the short term that we talk about it more as like a short-term play or short-term trade. And you do have an allocation to gold in your portfolio. When we look moving further to the right, you'll see that emerging markets and international stocks, they outperformed the US large company stocks. So they were up about 30%, where US large cap stocks were up 16%. Now, when you looked at the news, all I heard about were the Mag 7 and how well they were outperforming. At the beginning of the year, maybe we heard some noise around international and emerging because they had to really start spending more into their defense. So they were starting to put more money and investing back into that. But I didn't anticipate, and I don't think anybody really did, that they would be double their returns compared to US over the year. So it shows us again why we diversify and not put all of our money in large company US stocks, because over the past decade, that has been something people, why not just put everything in the S&P 500? And the reason that we diversify again is not to avoid or not to avoid risk. It's not to avoid bad asset classes or what have you. We diversify so we can manage volatility and seek out different opportunities throughout the year. And when you go to your next slide, you'll see really why a diversified portfolio works over time, this shows us that at the bottom you can see in gold shows the percent of this asset class in this portfolio. So, for example, US large stocks made up 30% of this diversified portfolio. There was only a 15% allocation to international stocks. Of the US large, that 30% allocation to US large cap stocks, the return from that was 5.2%, where the return from the international position was 4.5%. So if we had just switched it, if we had had 30% in international stocks versus 15, the return from that international position would have been 9%. And we would have had still good return from the US large company stocks, but the return would have just been different because we'd had more exposure to international. Now, I'm not saying like we should have had all in international or you might be wondering that, well, why didn't you guys do that? And again, we diversify across the different asset classes. A lot of you did have exposure to international. We work with different research teams to make sure that we are, seeking those opportunities and planning for 3 to 6 months, also 2 to 3 years out when we look at the timeline and the spectrum there. So next I want to talk about, so like I've explained to you like why the diversified portfolio works. And now I want to talk to you why staying invested works, because that was another thing that happened in 2025, a huge market pullback at the beginning of April. And I know myself and a lot of the advisors here got phone calls about what are we doing? Are we going to get out of the market? And you can see in this chart back in April, there's like a pretty steep decline that happened within a few days. I think it was around April 5th, and this was Liberation Day. So if you guys remember that, is when the current administration said that we're going to just put a blanket tariff across the board, and there was a lot of panicked selling within the market. Shortly after, I think it was within 4 or 5 days later, on April 9th, the market had the best performing day in the year. So what happened in this scenario is the green person that's staying fully invested. So you experienced the market decline and then you stayed invested throughout the entire year. Your return was 17.7%. However, the person that got a little scared, sold out, and then missed April 9th because their timing didn't work, their return for the year was 7.4%. So it's a 10% difference in their overall return because they missed one day. So this is why we are always advocating and encouraging you to stay invested, because just missing the one best day of the year can really make a difference in your portfolio returns and your long-term financial plan. So it's not just in the short run of this year, you're going to see that 10% loss or that you didn't get by staying invested. That's going to impact you for the rest of your life pretty much. So we encourage you, stay the course. We're not trying to avoid volatility. We're not trying to avoid loss. We create financial plans so that you can stomach the ups and downs, because what we've seen is that staying invested is the best way to overcome a lot of the market volatility and these scary times, for sure. So the next thing I want to talk about is your behavior, because behavior, I always think of it when people ask, like, what's the biggest risk to my financial plan? Ultimately, it's you, the investor, because you are going to have an emotional response when volatility happens, just like happened back in Liberation Day. And like even yesterday, I think the market was down close to 2%. And that doesn't feel good. If you look at your portfolio, you start to panic a little bit. This is also why we encourage you not to look at your portfolio every day, but we know that there are some of you out there that do. So this is where the best advisors are the ones that are going to coach you through these hard times. So yes, when the market is ripping and roaring, we look great. But really where we get you're going to get the most bang for your buck is by utilizing us during these market volatility periods and letting us coach you and encourage you to stick through it, and reminding you of the plan that we built for you. So
it's like financial therapy, really.
Yeah.
Exactly.
Yeah.
Yes.
Exactly. Yeah, so I want to walk you guys through, pull up the next slide. This shows us the emotional response of just an investor from 2006 to 2010. So going back to the Great Recession, the blue line is showing, the dark blue is showing us this person that was invested 60/40. The green you'll see is their emotional response. So things between 2006, 2007 are going up. And yes, I'm so happy I invested when I did. Then all of a sudden, beginning of 2008, things are going down. We hit mid-year, and you're like, ugh, there has to be a recovery soon. Keeps going down. And then this investor says, I can't take it anymore. I'm out. And they sell. Now, they didn't really sell at the bottom. You can see that the market continued to go down, and they're in cash at the lowest point, and they're happy they got out when they did because they avoided the loss. Okay, but then quickly the market starts to have a rally and it's going up. And remember, I showed you that the best days tend to be followed by the worst days, and it's pretty quick. It's not just, that's why timing is really hard, and it's about time in the market, not timing the market. So this person's still in cash, but the rally's going, and they're like, this can't keep going. They're still in cash, but 2010, 2009 to 2010, the market continues to go up. At some point, this investor says, shoot, I better buy back in. They finally buy back in, but they missed most of that rally. And then you can see the difference in their returns is about 20,000. So just by missing that, yes, they avoided some of that loss back in 2000, at the end of 2008, beginning of 2009, but they overall lost 20,000 in like potential returns because of making that decision. So we are
Rachel, can I
oh
just want
yeah.
to point something out real quick. So you can pull the chart back up, but those blue bars behind the chart are actually showing what people were doing at that time. So those blue bars are actually money flowing in and out. So when it's above the line, money's going into funds, and when the blue bar is below, it's going out. So you can see that's what people were actually doing. People were selling during this time frame. And the other thing I always point out behavior wise is no, like it says growth of 100,000, right? But if you look at the I'm so happy I invested when I did, that's the point where
Mm,
everybody anchors to.
It's
My
a
anchor is
psychological trigger. It is.
my my anchor is 115,000, not 100,000. And
yeah.
so the person who stayed invested the whole time, yeah, they're back to 111. But most likely from your own brain is thinking, oh, I'm still down. So it's just one of those things. That's why you need a coach. You need to have that financial advisor on your side to be like, yeah, but we're continuing to invest. We know that this is going to come back, and having that person to stop you from your worst impulses is so important.
Yeah. Yeah, I just can't reiterate enough how much the financial plans that we build for you are taking into account volatility, taking into account uncertainty. And it's not a short-term strategy, it's a long-term plan. So when people ask us, well, aren't you going to get me out of the market when things start to look bad? That's not a part of the long-term plan. We've already accounted for this type of volatility in those financial plans. So, what else is KWB doing for you guys besides just the financial planning, which is a lot of like our time and what we love spending more of our energy spending, or like when we're in meetings with you guys, that's what we really want to talk about. But in the background, if you can pull up the slide, the things that we are doing are like tax loss harvesting. So that happens annually. We're also doing rebalancing. We're making decisions on your portfolio every day. That's why we use different models. We have different model providers. Our advisory team gets together every Monday and talks about the markets. We are your emotional coaches. I know Claire experiences the same thing, getting on the phone with you guys when you're concerned. Please call us. We're here to help you. We don't mind when you call. I know some people, oh, I'm sorry for calling. Like, never apologize. That's what our job is, and we love doing it. We also do tax planning. So remember, I talked about the changes with the one big beautiful bill. We are looking at that and how that's affecting our clients. And we want to be proactive versus reactive. And then also, just as a company, our team is growing. KWB is now a team over 20 people that can help you, which I think is really exciting. It means that we can help more households. So as we grow, we can serve more people, and you're not going to lose that small feel of being an individual here at the company. One client, I remember them saying like what they love about KWB is that we're small enough team to make you feel important, but a big enough team to get things done. And I think that goes into my next point of we've been so successful and we're continuing to be successful, and we can't wait for the next years to come to serve you and the generations. KWB is celebrating our 30th year anniversary this year.
Woo!
So we've been in business for 30 years. KRE started in 1996, and we're excited for the next 30 years to come.
Thank you guys so much for attending. We look forward to 2026 and all the positives that we think are coming. And Taylor and Travis, I hope they have a very fruitful, wonderful
Yes.
wedding. And
Yes.
Do
We'll
we have
report
a
back next
date?
year on how it happened. I have no
Okay.
idea.
I
don't
know it's coming. I know
I
it's
Okay.
think it's like end of 2026. I'm not
Okay.
sure. So.
All right.
All right.
Well,
Thank you so much, everybody.
thanks everyone. Take care.
Thanks.